You are standing at a financial crossroad that almost everyone hits at least a few times in their adult life. You hit a sudden gap in your cash flow. Maybe an unexpected car repair pops up, or your utility bill comes in $50 higher than you budgeted, or you simply need a buffer to bridge the gap between this afternoon and your next paycheck. In that moment, your brain immediately starts evaluating options, and today, those options fall into two vastly different categories. To figure out which option actually serves you best, you first have to understand the fundamental problem both systems are trying to solve and why traditional banks are increasingly leaving everyday borrowers stranded in the middle. Traditional banks were built around a specific risk framework. If you walk into a major bank or apply online for a standard personal loan or credit card, the entire evaluation rests on hard metrics. They pull your credit score, analyze your debt-to-income ratio, look for a long history of stable traditional employment, and run a hard credit inquiry that temporarily knocks points off your score. For long-term wealth building, buying a home, or financing a vehicle, this structure works. But for short-term liquidity, it creates a massive friction point. If you suddenly need $100 to cover groceries before Friday, a traditional bank has almost no viable mechanism to help you. They do not issue personal loans for $100. Their minimum loan thresholds are often thousands of dollars, complete with multi-day approval processes, origination fees, and compound interest rates. The only mechanism a traditional checking account offers for a minor shortfall is overdraft protection, which is essentially a trap. If your account dips into the negative, traditional banks often charge flat overdraft fees that can range from $30 to $35 per transaction. Borrowing $30 through an account overdraft can end up costing you over $60 by the end of the day. This creates a pervasive fear among consumers. The primary fear with traditional banks is the debt spiral. You worry that taking out a traditional loan or carrying a balance on a high-interest credit card will lock you into monthly payments where interest compounds faster than you can pay down the principal. You fear damage to your credit score if an inquiry goes through and you don't qualify. While Credit Genie advertises 0% interest on its cash advances, fintech platforms sustain their business models through alternative fee structures. For instance, maintaining an active connection for financial monitoring and accessing features often comes with a recurring bi-weekly or monthly connection fee, such as $4.99 every 2 weeks. Additionally, if you need that $50 advance landed in your checking account in 30 minutes rather than 3 business days, you will pay an optional express delivery fee. While a $5 fee or a $2 delivery charge feels negligible in the moment compared to a $35 bank overdraft, you must evaluate the mathematical reality. If you pay $5 every 2 weeks to access small, recurring advances of $50 or $100, the annualized cost of accessing that capital is actually quite high when calculated as a percentage. The danger with fintech microadvances is that they can become a permanent crutch. Because the barrier to entry is so low and the advance amounts are small, users can easily fall into a cycle where every paycheck is automatically reduced by the previous week's advance, forcing them to take out another advance just to stay afloat. Furthermore, Credit Genie does not report your on-time advance repayments to the major credit bureaus. That means while a cash advance app can solve a temporary cash flow emergency, it does absolutely nothing to help you build a credit history. This brings us right back to traditional banks. Traditional banks may be slow, rigid, and unforgiving with fees, but they hold the key to long-term financial mobility. A traditional bank loan, credit card, or line of credit builds your credit profile. When you borrow money from a traditional bank and pay it back on time, that positive behavior is reported to Equifax, Experian, and TransUnion. Over time, this raises your credit score, opening the door to low-interest mortgages, auto loans, business capital, and premium credit products that fintech cash advance apps simply cannot offer. So, how do you decide which one to use? The actionable strategy comes down to matching the financial tool to the specific type of financial problem you are facing. If you are facing a short-term, immediate liquidity gap, meaning you need less than $150 to cover an essential expense before payday, and your credit score is currently too low to qualify for a low-interest credit line, Credit Genie and similar earned wage access tools are a far safer alternative than taking on a predatory payday loan or triggering a string of bank overdraft fees. It provides a localized safety net. But the rule for using fintech apps is strictly tactical. Use them sparingly as a bridge. Turn off paid subscriptions if you are not actively utilizing the tools, and avoid treating short-term cash boosts as supplementary income. Conversely, if you are planning for large-scale financial growth, consolidating significant debt, or trying to establish long-term financial stability, traditional banks remain essential. The proper approach to traditional banking is not to avoid it out of fear, but to engage with it strategically. Look for credit unions or community banks that offer low-fee checking accounts, secured credit cards, or credit builder loans designed specifically to help you establish a score without risking high interest rates. Opt out of traditional overdraft coverage so your debit card simply declines at point of sale rather than incurring a $35 fee. Ultimately, Credit Genie and traditional banks are not true head-to-head enemies. They are distinct tools sitting in different corners of the modern financial toolkit. Credit Genie operates like an emergency band-aid for immediate cash flow hiccups, while traditional banks build the structural architecture for your long-term wealth. Understanding how both work and precisely what each one costs you in fees or missed growth allows you to stop reacting to money problems out of stress and start using the right tool for the job.